Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karmali, live from Yahoo Finance's studios in London. It's Thursday, 9th October. Coming up on the show, Nvidia gets the green light to sell chips to the UAE. Gold prices stutter after President Trump hails a peace deal in the Middle East. And do you want to drive a car with 1,000 brake horsepower? Well, Ferrari has the car for you, and it's electric. So grab your coffee and let's own the morning. Well, the first thing you need to know is that Nvidia has been given the go-ahead to make chip exports to the United Arab Emirates. That's according to Bloomberg. This would mean several $1 billion worth of Nvidia chips will enter the Gulf country. The Commerce Department's Bureau of Industry and Security recently issued Nvidia export licenses under the terms of a bilateral artificial intelligence agreement hashed out back in May. Now, the deal would boost UAE's construction of data centers vital to developing AI models. The report said the approval came after the UAE made concrete plans for a reciprocal amount of investment on American soil. Now, the next thing you need to know is we'll be getting a big batch of Fed commentary during the day, including Chair Jay Powell. Now, remember, this will all be coming after minutes from the Fed's September FOMC meeting were released yesterday. There was some division at the Federal Reserve's last meeting about whether to cut interest rates and by how much. But most agreed the central bank could cut rates further this year. And the last thing you need to know is that gold prices are stuttering a little bit today as Israel and Hamas look set to sign a peace deal in Egypt. The news initially sent oil prices lower too, though as you can see they are starting to recover now. Gold has been on a tear, surpassing the $4,000 mark as worries of the health of the US economy and the ongoing shutdown has seen investors flock to the safe haven asset.
Obviously, gold has been getting a lot of attention recently. Do you think there's a case to be made that it should kind of always have a place in portfolios? And what place does it have? What kind of percentage allocation should people think about?
Julie, really great to be here. First, let me say it's a fascinating time to be an investor. At Twin Focus, we've owned gold in our portfolios for the better part of 2 decades. It's always been a 5-ish% position. Over the last few years, given our general outlook, macroeconomic outlook, we've let that position float. So it's up 100% over the last 2 years, up over 50% in this year. We think absolutely you should own gold. And it's not because you can eat it. It's not because it pays a dividend or you can burn it. It's just a great store of value. Listen, gold has had a 2,000-year history of calling bunk on currencies. And, we think it's a permanent position in our portfolios.
Do you think that the moment right now in this sort of narrative around the so-called debasement trade, that it is, in your words, calling bunk on the dollar? Is that what's really happening?
Everybody's talking about moving away from the dollar, and absolutely that's happening at the margin. Show me another currency that's deep enough to handle the flows, which is what you're seeing go on here with gold. The gold market is $25 trillion, probably about half the size of the U.S. stock market. U.S. stock market, no secret, is up 100% over the last 3 years. Gold is just kind of catching up. We're moving away from the dollar at the margin. Show me another currency that's better. Right now, the world thinks gold is a good place to be.
I also want to ask you about gold. Obviously, people are buying into it through ETFs. They're getting into futures, miners, for example. What about actual physical gold? Is there an argument to be made that you should have some gold bars at home or wherever?
We've shied away from owning bars. Bars, when it comes time to sell, are harder to sell because you have to kind of ensure the authenticity of that gold and the purity of the gold. We'd much prefer to own coins. Of course, this raises the question of where you store these coins. They have to be stored somewhere safe, and depending on how much you want to own. I mean, that said, $100,000 of gold is about that much in coins. So I suppose you could have a briefcase you carry around and keep the coins
with the little
with the handcuff
attached to it, like in the movies. Maybe so.
Well, for market movers, we're going to focus on earnings that have been released in the past hour or so. PepsiCo and Delta Airlines. We start with PepsiCo. It reported organic revenue growth of 1.3% for the third quarter. Well, that was below analyst expectations. Basically, US shoppers purchased fewer processed snacks and sugary sodas. Its Q3 earnings per share of $2.29 did beat the street. However, shares were a little bit up on the news in pre-market, as you can see, just below 2% there. Now, the owner of Lay's, Gatorade and Quaker Oats has been trying to keep up with shifting consumer tastes by expanding its healthier, high-protein and portion-controlled offerings. Over the year, its shares are down, however, as it is also facing pressure from economic uncertainty and Robert F. Kennedy Jr.'s health agenda. And don't forget, activist investor Elliott Investment Management last month took a roughly $4 billion stake and called on it to review and streamline its snack portfolio. Okay, let's move on to Delta now. And it reported better than expected earnings for the third quarter, helped by leisure travellers and a rebound in corporate travel. The markets seemed to like what they heard, and shares are up sharply in the pre-market. The carrier predicted continued strong demand into next year, with full-year earnings per share expected to be about $6, ahead of analyst consensus. Okay, well, to get more on those earnings from Delta and PepsiCo, I'm joined by Michael Landsberg, Chief Investment Officer at the private wealth management firm Landsberg Bennett. Michael, thanks so much for joining us. Well, let's start with PepsiCo. The markets initially seemed unmoved by those results, but are now starting to pick up a bit. How are you feeling about them?
Ramsey, I think what's interesting is they beat expectations, but reality is they made $2.31 a year ago quarter. They made $2.29 now. That's not at beating expectations. I don't focus on expectations. I focus on reported growth or reported earnings, and there is none. I mean, they're actually going backwards, and I think there's some pressure, obviously, RFK and the sugary snacks, as you mentioned, but also their statement was basically to tell Elliott, hey, we're looking at stuff, and don't buy more shares. They seem to be more concerned with an activist investor. I think right now it's a stock you probably want to stay away from because the earnings are not really, the growth's not there, and I think at the same time there's better places to put your money in that space.
What about Delta, though? What do you make of those results? They beat expectations, but as you say, you're not a man who looks at expectations. You want to see actual real numbers here.
Well, that was, for example, they earned $1.53 a year ago. They made $1.71 now. That's double-digit earnings growth. For a stock that trades at basically 8 or 9 times earnings, it's a cheap stock here. I think Delta's done a really nice job. The premium cabin, that's their market. They go after high-end, affluent customers. They spend money. They seem to be a little bit more insulated from any economic shocks. And I think they continue to do really well in that space. It's a tough space. Obviously, 50% of their, the costs are basically from comp for salaries and fuel. So I think they've got a lot of those things under control. Great management team. So yeah, if it's an airline space, this is really the one to own.
You say it's a tough space. It's probably got a little bit tougher over the last week or so. The Federal Aviation Administration delayed flights for a third straight day yesterday. Just how damaging is this time for the big three airlines during this government shutdown?
I think what's been good is they've kind of right-sized their schedules in the last couple of years. So I think what happens is they don't have as many flights. So I think all the flights that they do have, they're money-making, to the extent that they've got full flights. We know that when you get on a plane, there's not a lot of empty seats. You hear them calling and telling people you got to check their bags at the gate. So I think that's a positive from the standpoint. I think they're well positioned. I think in the comments from the CEO of Delta, he said there's not really any effects at all. If it drags on for weeks and weeks, I think so. I flew last week and didn't notice anything different. Plane was full. It happened to be a Delta flight. TSA moved pretty quickly. So knock on wood, things are pretty good there. But obviously the industry just had a bankruptcy with Spirit. So it's a tough market if you're not a good operator.
Michael Landsberg from Landsberg Bennett. Many thanks for your thoughts.
My pleasure.
Okay, it's time now for a short break, but when we're back, we'll take a deeper dive into the stocks that have got retail investors excited. Stay with us. Welcome back to Market Sunrise. Well, it's time now to hear from Jared Blickery, who took a look at what stocks retail investors are going for and why there's been a massive buying spree of big name brands. Let's take a listen.
Stocks have been rocketing higher since the post-Liberation Day April 8th lows. And over these 6 months, tech is surging. Chip stocks are flying and meme stocks are once again lighting up quote screens and Reddit boards. But how long can this retail investor-led buying spree last? That's what we're asking on today's Stocks in Translation. Let's dive in. Here's the quick scoreboard. Since stocks put in that capitulation low 6 months ago, the Dow is up 24%, while the Nasdaq is up twice that, nearly 50%. But check out the chip stocks, up 80%, and the disruptors in Cathie Wood's ARK Innovation Fund, left for dead in the wake of the 2022 bear market, it has more than doubled, up 120%. These incredible returns are suggesting that the AI trade is back and retail traders are once again asserting. But let's dig in some more. This bar chart right here from Morgan Stanley shows estimated retail demand going back a decade. The year-to-date total for 2025 is already $630 billion, more than all of 2021. And if the pace continues into year-end, that will mean $800 billion in retail buying, which is what the final bar on the right is showing. Importantly, Morgan Stanley says this is not a repeat of 2021 because first, households are not at peak stock exposure, at least by historical standards. Second, borrowing against stocks is smaller relative to the size of the market. And third, a lot of the money this year went into broad funds like ETFs, not just one-off hype names. So we're probably not at froth levels just yet. But let's talk some individual names. Over the last 6 months, it's fitting that Robinhood, the poster child for meme activity, is up an eye-watering 320+%. Then there's Coinbase, capitalizing on the crypto craze, up nearly 150%, followed by Palantir and Carvana, each of which has more than doubled. And while the names are familiar, the drivers are different than back in 2021. Back then, stimulus checks and pandemic boredom, they were the big drivers. Today, it's more AI news flow, chip cycles, cloud spending, and dreams of more Fed rate cuts. If the sprint slows, this is probably where you're going to see it first. So, how do we tell if things are cooling? You want to watch for a few simple things. First, a lot of retail buying is done through options, especially all-in call options. So watch for this activity dying down. Then watch price action in leading indexes and stocks. If the fresh record highs start drying up and leaders start pulling back, that's a tell. You could even watch the intraday activity of high-interest retail names, the so-called meme stocks. Are big pops on the open? Are they seeing more buying interest? Or are the so-called gaps getting sold? This is where classic candlestick charts can help identify weakness. And finally, Morgan Stanley argues that steady paychecks are a key to retail buying these days. So if the labor market continues to cool down and firings pick up, that means the rocket fuel is drying up. So here's what to watch next. We got to keep an eye on the jobs data as the fuel gauge. But the shutdown has literally shut down the biggest reports. As long as it goes on, we need to keep an eye on private reports like those from ADP and Challenger. The Chicago Fed also recently put together a great tool that estimates the official labor market numbers from the BLS. Then watch the AI headlines that move real money, especially as earnings season evolves in the second half of October. What's going on with the cloud spend, new chip launches, big orders, and data center builds. And then there's been a lot of big AI partnerships and mergers announced. Any new export or regulatory curveballs could throw cold water on this trend. And finally, this is perfect. As of October 8th, Roundhill is relaunching their meme stock ETF with the ticker MEME. That's your daily price action gauge in one of the most speculative corners in the market. Morgan Stanley says we're in the midst of the third retail wave that's emerged over the last year. If the flow stays strong, the sprint can keep going, but watch out when those simple tells start flashing red. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesday and Thursday on Yahoo Finance's website or wherever you find your podcasts.
Okay, time for another quick break now, but stay tuned to hear about today's trending stocks, which includes Ferrari, and its stock price is looking as red as its colours. Stay tuned. It's time now for today's trending tickers. Las Vegas Sands and Alibaba are in the spotlight. What do these two stocks have in common? Well, they are both closely tied to the National Basket Association, which just announced a return to China for the first time since a tense parting of ways in 2019. Now, the NBA will play 2 preseason games at Sands, China's Macau gambling resort, and it's launching a multi-year AI and cloud partnership with Alibaba. Sands is up in early trade, but only very slightly, while Alibaba is down in Hong Kong and New York. Now, there's one Chinese bank stock you probably wish you'd owned this morning. Hang Seng shares surged more than 25% after its longtime majority shareholder, HSBC, launched a $13 billion offer to privatise Hang Seng Bank. Now, on the other hand, HSBC shares, well, they fell 6% as the deal would suspend share buybacks to conserve capital. One more name in Asia, Fast Retailing, the owner of Uniqlo. Shares climbed over 3% on Thursday after the company reported strong full-year results. Fast Retailing reported full-year operating profit growth of 12.6% year-on-year. The company said these results marked the fourth consecutive record annual performance and that its new stores had been, quote, hugely successful. Jefferies is also trending after a steep drop in Wednesday's session of nearly 8%, but it's now recovering. It was up at one point in pre-market by nearly 5%, now just over 1% higher, which followed the disclosure that one of Jefferies' credit funds had more than $700 million exposure linked to the bankrupt auto parts company First Brands. Now, finally, probably the biggest stock move this morning, Ferrari. The Italian luxury car stock is deep in the red, both in New York and in Milan, after the company revealed new details of its first fully electric model, set to debut next year. It's the biggest decline for Ferrari since 2016. The thing is, demand for luxury EVs is cooling. Even high-end brands like Porsche and Mercedes have reported softer sales and scaling back production targets. So Ferrari is now stressing that these very powerful electric vehicles will represent only a small share of total output in the near term, and they'll focus on hybrid and limited editions instead. And that same Ferrari strategy of leaning into hybrid cars, well, we're hearing more analysts say Tesla should consider doing the same. Elon Musk's company announced lower prices for its top models, but how far can that strategy go? Garrett Nelson from CFRA shared his views with Julie Hyman here on Yahoo Finance.
We do think it will help them from a sales volume perspective, but only on the margin. It's really inevitable that Tesla is going to experience a pretty significant drop-off in sales volume starting this quarter, starting in Q4. The expiration of the federal EV tax credit is just too great of an event to prevent that, and it's at a time where EV sales are cooling across the board as is, and so this really doesn't help. And I think the announcement was a big disappointment. I think there was speculation that a lot of investors were thinking they might finally unveil the Roadster, which they promised a long time ago, or some other model, which didn't happen.
Something that our Autos reporter Prosper Ramani was pointing out earlier is, if you get rid of the tax credit and you have the cheaper base price of these lower price vehicles, is the car still more expensive than it would have been with the tax credit?
Yeah, it's a close call. You really have to do a case study analysis and exactly what you're getting for that money, which is a stripped down version. It's a less expensive, but it's has less features, a lower range, just not the same type of quality of vehicle that as a standard Tesla vehicle. So it's really a trade-off, and I think the question is, how much demand is there at this point for Tesla vehicles? We know they've been losing market share in the EV market in the US, in Europe, and China so far in 2025. They did have a much better than expected third quarter in terms of deliveries, but still, if you look at their year-to-date market share, it's lower than it was a year ago. And so, EV sales are cooling. The EV tax credit expiration it isn't going to help. And we think really the smartest thing that Tesla could do would be to introduce a hybrid vehicle, because that is a market that is growing very fast. If you look, hybrid sales in the US were up 37% last year, which compares to only 7% growth for pure battery EVs. So that's something we think Tesla should think about.
Bitcoin has, quote, no intrinsic value. That's the blunt call from the United Kingdom's biggest retail investment platform, Hargreaves Lansdown. Hargreaves issued a public warning to its clients after UK regulators allowed some crypto products for retail investors. The firm maintains that Bitcoin is not an asset class and that it lacks characteristics needed for use in growth or income portfolios. They bluntly assert performance assumptions are not possible to analyse for crypto. Now, having said all of that, they're not ruling out offering crypto ETNs, that's exchange traded notes, on their platforms. Yes, that sounds confusing, but that's the world we live in. As long as Bitcoin is worth so much, even the most skeptical investors can't afford to just sit on the sidelines. It will be interesting to see how the clients of this platform react, as the call is already drawing criticism by crypto believers. Okay, before we go, let's check in on the markets, and let's start in Asia. And mostly markets were in the green. And they rose today. They were boosted by tech. There's a lot of optimism over artificial intelligence that's driving investors into buying chip making and related stocks. Don't forget also that mainland Chinese markets, well, they were on holiday. They've just come back and the markets rallied there in a catch-up trade, I guess, after a week-long holiday. But the things that, however, what lagged on steep losses, Hang Seng did lag, as you can see there, and they were hit by steep losses in the health technology stocks. Now, this follows a report that Microsoft, the huge US tech giant, might be trying to enter into that market, into that sector. So that's interesting to see the Hang Seng down there, about 0.3%. But as you can see, the Nikkei still on its tear higher, yet another record high. This is after we've got a new prime minister due to take office later this month. Okay, let's turn to Europe now. And basically, it was a pretty slow start in the morning here, but things look like they are picking up slightly. The ongoing political uncertainty in France is clearly weighing on markets there, though they have recovered quite strongly in later trade in the morning. But one thing of note is in the UK is the Bank of England, the central bank here, has said that interest rates may need to stay higher for longer. And finally, let's see where Wall Street might open later this morning. And US stock futures, well, they're looking pretty muted right now, as investors are clearly waiting to hear from Fed Chair Jerome Powell during the day to get more clues on the interest rate path. Also, I told you about PepsiCo and Delta results. Well, after the closing bell, look out for Levi Strauss as well. Okay, that is it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. Coming up next, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. Go own the morning.